People constantly approach me with the same sense of urgency. Ray, what do you see coming? What should I be worried about? What should I do right now? They ask because they can feel the ground shifting beneath their feet. My answer is always the same, but the timeline has changed. We are no longer waiting for the storm. We are in 2026. This is the year I have been warning about for over a decade. The next 6 to 12 months will not just be another market cycle. There will be an absolutely critical inflection point in the big cycle that determines the rise and fall of empires and economies. I have been studying global markets and economies for more than 50 years. I've navigated 8 major crises, and if there's one thing I've learned, it's that the economy is a machine. Most people fail to see the big picture because they only experience a small fragment of history. I predicted the 2008 financial crisis when the consensus was that we had entered a great moderation. I saw it because the debt-to-income ratios were reaching a breaking point, a pattern that has repeated for centuries. Today, in 2026, the patterns I have been tracking, the long-term debt cycle, the internal order cycle, and the external order cycle, are all converging at once. This isn't fear-mongering. This is cold, hard pattern recognition. When you look at the data, the same indicators that preceded the 1930 to 1945 period are flashing red right now. What makes this specific 6 to 12-month window so perilous? It is the simultaneous peaking of 3 massive forces. The debt and money trap. We have reached the limit of late-stage debt cycles. Central banks are backed into a corner where they must choose between high inflation by printing money to pay debts or a crushing deflationary depression. In 2026, the real value of currency is being tested like never before. Internal social conflict. The wealth and values gap is at its widest since the 1930s. This leads to populism and extremism on both the left and the right, making the internal order of major powers, especially the U.S., increasingly fragile. Geopolitical reordering. For the first time since World War II, we have a multipolar world where great power rivals are challenging the existing reserve currency and the global rules of the game. The friction in trade, technology, and military posturing is no longer theoretical. It is 2026's reality. We are no longer preparing for 2026. We are living it. Some of what I predicted, the breakdown of globalization and the persistent sticky inflation, is already part of our daily lives. Other elements, like the radical restructuring of the global monetary system, are about to unfold in the coming months. In this environment, business as usual is a recipe for disaster. Based on historical patterns, the winners of the next year will be those who understand diversification across currencies, countries, and asset classes. You must move away from a mindset of investing for growth and toward the mindset of navigating a paradigm shift. The machine is resetting. If you don't understand the mechanics of this reset, you are at the mercy of the cycle. The window to prepare is still open, but barely. Every week that passes, that window closes a bit more. By the time we reach late 2026 or early 2027, it will be too late to position yourself defensively. The preparation needs to happen now, immediately, in the next 30 to 90 days. Today, I want to walk you through exactly what I see unfolding in 2026 across 5 critical domains. The economy, where we are now and what's coming next. Markets, what's happening and how to position. Geopolitics, the flashpoints reaching critical mass. Technology, AI disruption that's already here. Society, the tensions breaking into the open. And most importantly, I'll give you an immediate action plan for each domain. Not vague advice, but specific steps you can take in the next 30 days to position yourself for what's coming in the second half of 2026. This is the most urgent video I've made in this series, because this is happening now. Your decisions in the next 30 to 90 days will determine whether you're a victim or a beneficiary of what unfolds in the second half of this year. Let's begin. 2:30 to 7:15, domain number 1, the economy, where we are now. Let me start with the economy because everything else flows from this. As we sit here in early 2026, the U.S. and global economy is at a critical juncture. We're seeing three possible paths forward, and over the next 3 to 6 months, it will become clear which path we're on. Path 1. Recession, 45% probability, rising. A traditional recession is becoming increasingly likely as I record this. What we're seeing now, interest rates have been elevated for nearly 3 years. The Fed raised rates from near 0 to 5% plus starting in 2022, the fastest hiking cycle in 40 years. And now, in 2026, we're finally seeing the full impact. Current warning signs, as of early 2026 credit card delinquencies, rising commercial real estate distress, increasing small business bankruptcies, accelerating consumer spending showing signs of fatigue, leading economic indicators turning negative. What's coming in next 6 to 12 months? If we're heading for recession, which I now think is 45% likely, here's the timeline. Q2 2026. Now. Next 3 months, economic data continues weakening. Unemployment starts ticking up from current 4% toward 4.5 to 5%. Corporate earnings disappoint. Fed starts hinting at potential rate cuts. Q3 2026. 3 to 6 months from now, official recession begins. 2 consecutive quarters of negative GDP. Stock market declines accelerate, down 20 to 25% from current levels. Fed begins cutting rates, but it's too late to prevent recession. Q4 2026. 6 to 9 months from now, recession deepens. Unemployment reaches 6 to 7%. Stock market bottoms, down 30 to 35% from peaks. Corporate layoffs accelerate. How to position now if recession is coming. 45% chance. Increase cash immediately to 20 to 25%. A portfolio shift into defensive stocks, consumer staples, healthcare, utilities. Add short to intermediate treasury bonds. They'll rally as Fed cuts rates. Avoid cyclical stocks and high growth. Unprofitable tech. Path 2. Stagflation, 40% probability. My biggest concern. This is what keeps me up at night. What we're seeing now, interest rates have been elevated for nearly 3 years. The Fed raised rates from near 0 to 5% plus starting in 2022, the fastest hiking cycle in 40 years. And now, in 2026, we're finally seeing the full impact. High inflation persisting while economic growth stalls or turns negative. What we're seeing now, inflation has been stubbornly sticky. The Fed got it down from 9% in 2022 to around 3 to 3.5% currently. But it's proving very difficult to get that last bit down to the 2% target. Meanwhile, economic growth is slowing. We might be experiencing stagflation right now without fully recognizing it yet. Current warning signs. Core inflation still above 3% despite aggressive rate hikes. Wage growth persistent. Workers demanding raises to offset inflation. Supply chain issues still not fully resolved. Energy prices volatile. Geopolitical tensions adding inflation pressure. What's coming in next 6 to 12 months? If we're in stagflation, 40% likely. Q2 2026. Inflation refuses to come down below 3 to 3.5%. Economic growth slows or turns slightly negative. Fed is trapped. Can't cut rates, would worsen inflation. Or raise rates, would worsen recession. Q3 2026. Stagflation becomes undeniable. Both stocks and bonds struggle. Political pressure on Fed intensifies. Q4 2026. Policy paralysis as Fed has no good options. Real inflation adjusted returns negative. Across most asset classes, social unrest increases as purchasing power declines. How to position now if stagflation is coming. 40% chance. Gold immediately increase to 15 to 20%. A portfolio now tips inflation protected bonds. 25 to 30% allocation. Commodities and energy stocks. 10 to 15% real estate with fixed rate debt. Debt gets inflated away. Avoid long-term nominal bonds. They get destroyed. Path 3. Soft landing, 15% probability. Unlikely. The optimistic scenario. The Fed manages to bring inflation down without causing recession. We're seeing now, interest rates have been elevated for nearly 3 years. The Fed raised rates from near 0 to 5% plus starting in 2022, the fastest hiking cycle in 40 years. And now, In 2026, we're finally seeing the full impact. High inflation persisting while economic growth stalls or turns negative. What we're seeing now, inflation has been stubbornly sticky. The Fed got it down from 9% in 2022 to around 3 to 3.5% currently. But it's proving very difficult to get that last bit down to the 2% target. Meanwhile, economic growth is slowing. We might be experiencing stagflation right now without fully recognizing it yet. What this would look like? Over the next 6 months, inflation gradually falls to 2 to 2.5%, while economic growth remains positive at 1.5 to 2%. Labor market softens gradually without spiking unemployment. Stock market muddles through with modest gains. Why I'm skeptical? As I sit here in early 2026, I see too many warning signs for this scenario. The historical record of soft landings is poor. The Fed almost never threads this needle. I give this only 15% probability now. My updated base case. I now assign 45% probability to recession, 40% to stagflation, 15% to soft landing. That means 85% probability of significant economic stress over the next 6 to 12 months. You must position defensively now. Don't wait to see which scenario unfolds. By the time it's obvious, it's too late. The key indicators I'm watching right now. Weekly unemployment claims. Watch for sustained rise above 250,000. Monthly CPI reports. If stays above 3% through summer 2026, stagflation risk intensifies. Corporate earnings reports. Q2 2026 watch for margin compression and revenue misses. Credit spreads. If high-yield spreads widen above 5%, major stress signal. Fed commentary. Any hints of policy shift tell us which scenario they see. I check these indicators weekly. You should too. They'll tell you in real time which path we're on. All right, let's talk about what's actually happening in markets right now in early 2026 and where I think they're heading over the next 6 to 12 months. Stock market, current situation. As I record this in early 2026, the stock market is showing classic late cycle behavior. High valuations, S and AMP wink with tongue sticking out, 500 still around 20x forward earnings. Narrow leadership, few stocks driving most gains. Declining breadth, fewer stocks participating in rallies. Increased volatility, bigger daily swings. My forecast for next 6 to 12 months. Base case, down 25 to 35% from current levels by Q4 2026. The timeline I expect, May-June 2026. Market peaks or has already peaked July-September 2026. Decline accelerates as recession/stagflation becomes clear October-December 2026. Market bottoms, down 30 to 35% from highs early 2027. Recovery begins for those positioned to buy the bottom. What to do right now? This week, take profits on big winners, anything up 50% plus from purchase. Reduce exposure to high P/E tech stocks with no profits, shift toward defensive sectors this month. Rebalance to 40 to 50%. Stocks for whatever you have now. Within stocks, emphasize consumer staples, Procter & Amp, Gamble, Coca-Cola, Walmart, Healthcare, Johnson & Amp, Johnson, United Health, Pfizer Utilities, regulated utilities with steady dividends, cut speculative positions. To zero bond market, current situation. Bonds are in a precarious position right now. 10-year Treasury yield around 4.5%, corporate credit spreads starting to widen, inflation expectations still elevated. My positioning for next 6 to 12 months. Recession scenario. Long-term bonds rally, yields fall, prices rise, stagflation scenario. Long-term bonds get crushed, inflation persists. Given 40% stagflation risk, I won't take that bet. Stock market, current situation. As I record this in early 2026, the stock market is showing classic late cycle behavior. High valuations, S and AMP wink with tongue sticking out, 500 still around 20x forward earnings. Narrow leadership, few stocks driving most gains. Declining breadth, fewer stocks participating in rallies. Increased volatility, bigger daily swings. My forecast for next 6 to 12 months. Base case, down 25 to 35% from current levels by Q4 2026. What to do right now? This week, exit all long-term bonds, 10 plus years. Move to short to intermediate, 1 to 5 years. This month, allocate 25 to 30% to TIPS, inflation protection. 15 to 20% to short-term treasuries, 1 to 3 years. Total bonds, 40 to 50% of portfolio. 0 in long-term nominal bonds. Real estate, current situation. Residential, still elevated in many markets, showing signs of cracking. Commercial, in serious trouble. Office vacancy rates at multi-year highs. What's coming? Residential, expect 10 to 20% declines in overvalued markets, Austin, Miami, Boise, Phoenix. Commercial, expect significant distress, defaults, foreclosures, especially office. What to do right now? If you own primary residence, don't panic. If you have fixed-rate mortgage, ride it out. Don't try to time the market by selling and renting. If you're thinking of buying, wait. Prices will be better in 6 to 12 months. Build cash to buy at bottom in late 2026/early 2027. If you own investment properties, if highly leveraged with variable rates, consider selling now. If fixed rate, low leverage, hold. Commodities, current situation and AMP, forecast. Gold, currently around $2,100 to $2,300 per oz. My forecast, $2,800 to $3,200 per oz by Q4 2026. Why? Both recession, flight to safety, and stagflation. Inflation hedge scenarios benefit gold. What to do right now? This week, start buying gold if you're not already at 10 to 15%. This month, build full 15 to 20% gold position. Hold through 2026. Don't sell when it hits $2,500 or $2,700. Hold for full move. Energy, currently volatile, geopolitical tensions supporting prices. Forecast, depends on recession versus stagflation. Recession, oil falls to $60 to $70. Stagflation, oil rises to $100 to $120. Positioning, keep 5 to 10% in energy as hedge, not as core bet. Crypto, current situation. Bitcoin and crypto remain highly volatile and speculative. My view, too risky as core holding in current environment. What to do? If you have crypto, reduce to 2 to 5% maximum. This is not the time for speculation. The defensive portfolio for right now, early 2026, 25% cash, money market earning 4 to 5%, ready to deploy at lower prices. 20% TIPS, inflation protection. 15% gold, crisis hedge. 15% short-term treasuries, recession hedge if it hits. 15% defensive dividend stocks, quality, low PE, high dividends. 10% energy/commodities, stagflation hedge. Total, 100%, position for 85% probability of stress scenarios. This is what I'd hold right now if I were starting fresh. Adjust your current portfolio toward this over the next 30 days. 12 to 1630, domain number 3, geopolitics, flashpoints in 2026. Now let's talk about geopolitics, because the geopolitical situation is deteriorating as we speak in 2026. Flashpoint number 1, U.S.-China tensions. At critical point where we are now, early 2026 U.S.-China relations are at their lowest point in decades. Trade restrictions escalating, tech decoupling accelerating, semiconductors, AI, military posturing around Taiwan, increasing South China Sea incidents becoming more frequent. What I'm watching in next 6 to 12 months. Highest probability, 60% continued escalation short of war, more trade restrictions, possible Taiwan incidents, Chinese exercises, U.S. Freedom of navigation operations. Tech Cold War deepens supply, chain disruptions medium probability. 30% serious crisis, Chinese blockade or quarantine of Taiwan, major military incident, in South China Sea markets panic. 20 to 30% crash in days, but cooler. Heads prevent actual war, low probability. but catastrophic. 10% actual military conflict would be economic catastrophe, global supply, chains collapse, markets crash 50% plus. What to do right now? This month. Reduce exposure to China-dependent companies, Apple, Tesla, major semiconductor firms. Diversify to companies with India, Vietnam, Mexico manufacturing. Increase defensive assets, gold, treasuries, as geopolitical hedge. Flashpoint number 2. Russia-Ukraine. Grinding on current situation, early 2026. War continues with no resolution in sight. The defensive portfolio, for right now, early 2026. 25% cash, money market earning 4 to 5%, ready to deploy at lower prices. 20% tips, inflation protection. 15% gold, crisis hedge. 15% short-term treasuries, recession hedge if it hits. 15% defensive dividend stocks, quality, low PE, high dividends. 10% energy/commodities, stagflation hedge. Total, 100% position for 85% probability of stress scenarios. This is what I'd hold right now if I were starting fresh. Adjust your current portfolio toward this over the next 30 days. 12 to 1630, domain number 3. Geopolitics, flashpoints in 2026. Now let's talk about geopolitics, because the geopolitical situation is deteriorating as we speak in 2026. Europe facing ongoing energy insecurity, economic weakness, political fragmentation, defense spending increases. What's coming? This war is unlikely to end in 2026. It will continue grinding on, keeping Europe weak and energy prices elevated. Impact on investors. European stocks underperform, avoid overweight Europe. Energy remains elevated, maintain energy exposure. Defense stocks continue doing well. Flashpoint number 3, Middle East, tinderbox. Current tensions. Israel-Gaza ongoing. Iran nuclear program advancing. Regional proxy conflicts. Saudi-Iran tensions despite recent détente. The risk in 2026. Escalation to broader regional conflict involving Iran directly. If this happens, oil spikes to $100 to $130 per barrel. Stagflationary shock to global economy. Flight to safety in markets. What to do? Maintain 5 to 10% energy exposure as geopolitical hedge. Be prepared for oil price volatility. Have stop losses on energy positions. Could also crash if recession hits. The geopolitical bottom line for 2026. We're in the most dangerous geopolitical environment in decades. Multiple flashpoints. Rising great power competition. Risk of miscalculation. Portfolio implications. Don't be 100% invested in risk assets. Maintain 20 to 25% cash/safe assets. Diversify internationally, but carefully. Avoid concentration in vulnerable regions. Maintain geopolitical hedges, gold, energy, defense stocks. Prepare for sudden volatility. The next 6 to 12 months could see geopolitical shocks. Be ready. 1630 to 2015, domain number 4. Technology, AI disruption is here now. Let me shift to AI, because what I predicted would happen is happening right now in 2026. Where we are, early 2026 AI capabilities have advanced dramatically. GPT-5 class models are here or coming within months. AI can now handle most routine knowledge. Where companies are beginning mass deployment. Job displacement is starting. What's happening right now? Early 2026 developments. Major companies announcing AI-driven workforce reductions. Customer service jobs being eliminated at scale. Junior-level work in law, accounting, consulting being automated. Content creation, writing, design, video, heavily AI-assisted software engineering, seeing AI pair programming become standard. What's coming in next 6 to 12 months? By Q4 2026, unemployment starts rising partially due to AI displacement. Hard to separate from recession, but it's a factor. Productivity gains become visible in corporate earnings for AI adopters. Clear divergence between AI winners and losers. Social and political backlash against AI acceleration begins. Investment implications for next 6 to 12 months. Winners: AI infrastructure, NVIDIA, Microsoft, Google cloud providers. Companies successfully deploying AI varies by sector. Cybersecurity: AI creates new threats. Companies with irreplaceable human expertise losers. Labor-intensive businesses with automatable tasks. Companies slow to adopt AI, losing competitive edge. Traditional education models. AI tutoring disrupting. Media and content businesses. AI generation disrupting. What to do right now? Personally, learn to use AI tools in your profession this month. Develop skills AI can't replicate: leadership, creativity, complex judgment. If your job is high risk for automation, start exploring transitions now investment-wise. Reduce exposure to labor-intensive, automatable businesses, increase exposure to AI infrastructure, and successful adopters diversify. We don't know exactly who wins/loses. My concern for late 2026. The speed of displacement may exceed society's ability to adapt. Portfolio implications: don't be 100% invested in risk assets. Maintain 20 to 25% cash/safe assets. Diversify internationally, but carefully. Avoid concentration in vulnerable regions. Maintain geopolitical hedges: gold, energy, defense stocks. Prepare for sudden volatility. The next 6 to 12 months could see geopolitical shocks. Be ready. 1630 to 2015, domain number 4. Technology. AI disruption is here now. Let me shift to AI because what I predicted would happen is happening right now in 2026. This could contribute to rising unemployment, especially among routine knowledge workers. Political backlash and regulation could slow AI progress. Social unrest, displaced workers equals angry voters. This is happening now in 2026, not in some distant future. Position accordingly. 2015 to 2330, domain number 5, society, tensions breaking open. Finally, let's talk about what's happening socially and politically right now in 2026. Where we are, early 2026. Social and political tensions are at extremely high levels. Economic stress building, recession/stagflation fears. Wealth inequality at near record highs. Political polarization extreme. Trust in institutions at all-time lows. What's happening in 2026? This is a critical election year. U.S. midterm elections in November 2026. These will be highly contentious given economic conditions, likely recession or stagflation by November. Political divisions at extremes. Contested narratives about who's to blame. Several European countries also have elections in 2026. While I'm watching for the next 6 to 12 months. Economic stress driving political volatility. If unemployment rises or inflation persists through summer/fall 2026, incumbent governments face enormous political pressure. Populist movements gain strength. Political extremes, both left and right, gain ground. Moderate center weakens. Potential for social unrest. Summer/fall 2026 risk factors. Protests against economic conditions. Labor strikes, workers demanding wage increases. Political demonstrations around elections. Potential for violence at political events. I'm not predicting civil war, but I am predicting elevated social tensions and possible unrest in late 2026. Generational tensions intensifying. Younger generations increasingly frustrated. Housing unaffordable. Student debt burden. Job prospects weakening. Climate anxiety. AI displacement fears. This frustration will find political expression in 2026 elections. How to prepare. Community level. Build strong local networks now. Don't let political differences destroy personal relationships. Focus on community resilience. Financial level. Don't assume political stability in investment planning. Consider some international diversification. Don't have 100% in U.S. assets. Have contingency plans for political volatility. Personal level. Cultivate emotional resilience. Seek to understand different perspectives. Focus on what you can control. Late 2026 will be turbulent politically and socially. Be prepared. All right, let me give you the immediate action plan. We're in early 2026. You have 30 to 90 days to position before the second half of 2026 likely brings significant stress. Days 1 to 7. Emergency assessment and AMP. Actions day 1 to 2. Portfolio review, calculate current allocation to stocks, bonds, cash, gold, other assess total exposure to risk assets. Identify most vulnerable holdings day 3 to 4. Immediate rebalancing starts, exit all long-term bonds, 10 plus years. Immediately, take profits on any stock up 100% plus from your cost basis. Reduce any position that's greater than 15% of portfolio day 5 to 7. Cash building, target 20 to 25% cash by end of week, open money market account if needed, earning 4 to 5%. Sell most speculative positions days 8 to 30. Defensive repositioning week 2. Add protection by gold. Target 15 to 20% allocation by tips. Target 20 to 25% allocation. These are your hedges against both recession and stagflation week. 3. Reposition equity. Reduce total stock allocation to 40 to 50% within stocks. Shift to defensive. Consumer staples 15%. Healthcare 15%. Utilities 10%. Quality dividends 10% week 4. Fixed income positioning, allocate 15 to 20% to short-term treasuries, 1 to 3 years. Total safe fixed income, 35 to 40%. 0 in long-term bonds days, 31 to 60. Advanced preparation week 5. Geopolitical hedging, reduce China-dependent holdings, add 5 to 10% energy/commodities as geopolitical hedge, review international. Diversification week 6. Income security if employed. Update resume, strengthen network if self-employed, diversify client base, build 6 to 12-month emergency fund week 7. Skill development, learn AI tools relevant to your profession develop. Automation-resistant skills, explore side income possibilities week 8. Review and AMP. Adjust, check portfolio is at target allocations, set monitoring schedule, weekly check-ins. Document your investment thesis days 61 to 90. Final preparations week 9. Scenario planning, plan response if stocks fall 30%, plan response if inflation stays at 4% plus, plan response if unemployment spikes week 10. Community building, strengthen local relationships, join or create support networks, don't isolate. Week 11. Knowledge building, red, principles for navigating big debt crises. Study 1970 stagflation, study 2008 crisis week 12. Final review, confirm all defensive positions in place, set alerts for key economic indicators, commit to your plan. The target portfolio for right now. Early 2026, 25% cash/money market, optionality plus safety, 20% tips, inflation protection, 15% gold, crisis hedge, 15% short-term treasuries, recession hedge, 15% defensive dividend stocks, quality equities, 10% energy/commodities, geopolitical plus stagflation hedge, total 100%. Ready for 85% probability scenarios, the most critical actions. Act this week. Start rebalancing immediately, don't wait for confirmation. By the time it's obvious, it's too late position. Defensively, assume 85% stress scenario, stay informed. Monitor indicators I mentioned weekly, execute calmly. Having a plan prevents panic. We're in early 2026. How to prepare. Community level. Build strong local networks now. Don't let political differences destroy personal relationships. Focus on community resilience. Financial level. Don't assume political stability in investment planning. Consider some international diversification. Don't have 100% in U.S. assets. Have contingency plans for political volatility. Personal level. Cultivate emotional resilience. Seek to understand different perspectives. Focus on what you can control. Late 2026 will be turbulent politically and socially. Be prepared. All right, let me give you the immediate action plan. We're in early 2026. You have 30 to 90 days to position before the second half of 2026 likely brings significant stress. The second half of this year will likely be very challenging. But those who prepare now will not only survive, they'll be positioned to profit when opportunities appear at the bottom. The difference between those who get crushed and those who thrive isn't luck. It's preparation. You have 30 to 90 days. After that, events may move too quickly to reposition effectively. Subscribe to this channel for ongoing updates throughout 2026. I'll be monitoring developments weekly and sharing critical insights. And remember, we're not preparing for the crisis anymore. We're in it. Act accordingly. Thank you for watching. Now go execute your plan immediately.